even if banks may like to go up on the risk curve, where is the product? If you have an equity-rich buyer who has very much difficulties to deploy his capital, and he says, I need to invest 30–40%. I don't need 80% LTV, because I have equity to place. It's not my game to leverage up to the maximum level. That's the exercise we have seen in 2006 and 2007. This is not the case at the moment. At the moment, you have very deep pockets, money, still flowing into Europe, so at the moment, it is not a matter of prudence or a different banking behavior that drives LTV and keeps LTV relatively low. I think it is the big amount of equity still that needs to be deployed. If ever, however, there comes an opportunity for a higher risk financing, there is money abundantly available. We see what is going on in Spain at the moment. In Spain, which is a market which is determined at the moment by a large number of transactions where you have a recapitalization of listed companies, where you have investment of distressed equity positions, or where you have investments in secondary loan positions. In all of this, let's say, transactions which are higher on the risk curve, financing is available to a large extent again by American banks, by European banks, by German banks. All those financing partners, they are following their clients, and as the clients are going into those markets, it's only a matter of time when finance providers will follow. There was a project in Castellana in Madrid a couple of weeks ago where we have a building which is mixed use. You have a part which is retail, a part which is office. Office is still substantially vacant. So it is Spain, it is added value, it is certainly higher on the risk curve, and there were about 30 to 40 bidders on the equity side, and also a large number of financing providers that were willing to follow this project. If the investors are there, the financing parties will follow, that's for sure.
And I really think going up higher the risk curve at the moment means expanding where you go also in geography, because really, as you quite rightly said, the equity is there anyway, and now we see a couple of markets re-entering focus, and Spain is a very good example for that. It's a lot of finance available, but also for some of the Central European countries where we've seen very low activity for a couple of years, and that was partly also led by the lack of finance. There are people coming back who are willing to lend, and that's going to be kickstarting, moving up the risk curve but that means geography also partly.
What we have to keep in mind, getting into, let's say, a more challenging market does not necessarily mean going up on the yield curve. If you find a very attractive investment in Spain at the moment, in a market that saw rent levels on the office side in Madrid of about 35 to 40 euros. Nowadays, prices for letting of office space in Madrid came down to a level of 20 to 25. So from an investor perspective, getting back into this market in an excellent location does not necessarily mean that it is a high-risk investment. It's just the number of opportunities is not there, at least not in the Spanish market. This may come this might become more liquid if all those traded portfolios will be then spread out to the final investors in maybe 12 or 24 months. But it is also in those countries where you have a very, very strong investment hype, even in Spain, without the fundamentals haven't really changed. I think there is also a lack of product to be available both for the investors and the financing parties. But again, it is not necessarily high risk to go to Spain, because the point of entry might be very interesting and very defensive.